Hi everyone, and thank you for returning to Everything Tesla stock. Going into mid-2022, Tesla Incorporated is well positioned, with bullish analysts predicting that the company's stock would soar to a new all-time high as early as next month. Global analysts are speculating that if Tesla continues on its current trajectory, the price may end up higher than anticipated. With a 55% price increase this year, Tesla stock has had an incredible year, pushing the company's market value above $1 trillion. Renowned stock market expert Daniel Ives has said that Tesla anticipates hitting $1,400 in stock prices next month. Dan Ives is a senior equity analyst at Wedbush Securities and a managing director who specializes in the software and technology industry. Dan is a reliable source because he is among the top 10 stock analysts in the world and has been tracking Wall Street's broader technology sector for almost 20 years. Ives has set a new goal price of $1,400 for Tesla to start trading at the end of the month. After that, Ives increased his price objective for Tesla stock to an all-time high and predicted that the business will be important to the emerging EV market. In a new note to Wall Street clients, Wedbush increased its price estimate for Tesla from $1,100 to $1,400 per share. Ives estimates that the manufacturer of electric vehicles is currently valued at $5 trillion, of which Tesla may hold $2.5 trillion by 2022. Wedbush has increased their price target from $1,100 to $1,400, with a bull case of $1,800. Based on their estimation that China is worth $400 a share in a Tesla story. A lot has transpired in the first quarter of this year, and Tesla, the electric vehicle business, has not had an easy ride. Ives mentioned that the numbers from the previous quarter were excellent. He wholeheartedly concurs that the company's earnings, which came in at $2.52 per share as opposed to analysts' predictions of $2.36 per share, were just marginally better than analysts' expectations. Additionally, revenue exceeded experts' projections by $16.77 billion to $17.72 billion. Ives wrote in a note to investors that global logistical problems and chip scarcity continue to be the auto industry's main obstacles. Tesla's impressive performance indicates that, despite the presence of multiple competitors in the electric car market, the company's demand trajectory for these vehicles is strong and has been growing since the start of the year. Despite the shortage of chips, Tesla maintains its dominant market position, and after a difficult start in 2021, demand in China is once again increasing. While safety concerns and public relations were major concerns in China early in the year, Ives added that it looks like demand and trend would soon turn bullish for Tesla near the end of the year, with the company now on a 50,000 run rate for China in 2022. Ives' letter states that Tesla will spearhead the auto industry's transition to electric vehicles, with estimates indicating that the shift to clean energy vehicles will cost $5 trillion over the course of the next 10 years. Ives argues that the launch of more gigafactories in Austin and Berlin this year will be the second factor driving Tesla's success, as it will help to relieve global production bottlenecks for the company. Wedbush claims that by the end of 2022, Tesla would be able to produce around 2 million units annually, up from about 1 million in 2021. Furthermore, Wedbush forecast that this dynamic would drastically diminish in the future, with 1.4 million to 1.5 million units being within reach annually for 2022. While supply chain problems and worries have hindered Tesla's overall unit growth in 2021, this growth was also hindered in 2021. Although we think demand for Tesla's Model Y is growing in the US and Europe, we still think China will be a major growth driver. 2022 will probably be another breakthrough year for Tesla and the EV industry, Ives stated. Dan Ives added that Tesla is in a strong position going into the year and has an important turning point because Musk and company have handled the scarcity of chips better than any manufacturer over the last 6 months. Ives said that the green tidal wave will create a $5 trillion market opportunity over the next 10 years, with Tesla leading the way, and that Wall Street is still processing the enormous disruption that the EV revolution will bring to the auto industry in 2022 and beyond. It looks that Ives' target price is based on the most recent quarter results for the company. Meanwhile, a few analysts predict that Tesla will report higher than expected earnings this quarter. For example, Trip Chowdhury, managing director of global equities research and senior analyst, recently finished researching the typical Tesla plant and is rather optimistic about the company's prospects for delivery, shipping, and production. Chowdhury claims that Tesla has had a reasonably solid quarter. He said that he expects Tesla to post better first quarter earnings this year than it did last year next month. As a result, we believe that as the first quarter of the year draws to a close, IVE's target price of $1,400 is actually becoming more plausible. Tesla's production and delivery have been hindered by the most recent lockdowns in China. Estimates suggest that the company exported just 1,512 vehicles from its Chinese plant in April. In a normal month, the business planned to supply between 60,000 and 70,000 units. Ives maintains his positive assessment of the firm despite these difficulties, saying, "We maintain our outperform rating with our views that after the June quarter doldrums, Tesla will start to see some smoother sailing in China and into the second half of the year, with momentum into 2023. Surprisingly, 10% of EV adoption in 2025 and 30% in 2030 are the cautious adoption rates still used in that report. However, Ives thinks China will be crucial to Tesla's expansion in the near future, contributing 40% of the company's shipments in 2022. Additionally, according to Ives, Tesla's Model 3 and Model Y car production is being negatively impacted by the present supply chain issues by about 15%. The lack of semiconductor components continues to be a challenge for Tesla and all other automakers. With our primary focus on Model 3 and Y demand, which is now outpacing supply by about 15%, we see this as a temporary problem. Ives claims that Tesla stands to benefit from President Joe Biden's $550 billion infrastructure initiative, which is anticipated to strengthen the nation's electric vehicle sector and increase demand in China. Additionally, the street's conviction in this generational growth story is demonstrated by Tesla's return to a $1 trillion market cap. Ives claims that Musk is demonstrating his might with the building projects in Austin and Berlin, as well as the state of EVs. In Tesla's universe, everyone else is currently paying their rent. With Apple Incorporated purportedly looking to expedite the construction of its own electric vehicle, the competition in this space is getting fierce. Wedbush analyst Ives added in a follow-up note that Apple may collaborate with Tesla to produce its own cars the following year. Additionally, even though Tesla is profitable, some investors might find its 0.76% NTM FCF yield disconcerting. Investors should be aware of Tesla's ability to expand production and delivery to the company's FCF yield, which is comparable to a growth stock multiple. However, if Tesla stumbles and falls short of expectations, there might be a significant value compression. Additionally, Tesla has shown its ability to integrate vertically during the last 2 years of supply chain issues in the automobile industry. It has the capacity to produce its own battery cells as well. We are presently waiting for Giga Texas to deliver its 4680 battery pack. In addition, Tesla has been securing long-term raw material supplies that are critical to the chain that provides batteries, thereby raising the visibility of its own operations. It has long-term agreements with Chinese company Ganfeng Lithium. Additionally, it has long-term agreements with Australia's Cicero Resources. Moreover, investors tend to overestimate Tesla's capacity and proficiency in producing batteries. Traditional rivals of Tesla have forged partnerships with South Korean battery manufacturers. The relationship is more nuanced than it first seems, though. Businesses are aware of Tesla's large manufacturing volume and high-end demand. As a result, battery producers who wish to collaborate with Tesla will continue to show a great deal of interest in it. The largest battery producer in the world, CATL, has disclosed intentions to construct an 80 gigawatt-hour monolithic factory in the United States. Giga Shanghai is where CATL, a vital Tesla partner in China, supplies LFP batteries for Tesla automobiles. That CATL will give American Tesla orders priority over all other orders is incomprehensible. Because of this, we think Tesla has a significant edge over the other manufacturers in terms of the security of its battery supply. In the long run, these advantageous traits should support Dan Ives' bullish prediction for Tesla stock. In the meantime, analyst Philippe Halchois of Jefferies increased his price target for Tesla to $1,400 per share, the highest on Wall Street, from $950 in a letter to investors. This is the main argument he makes about why traditional manufacturers are attempting to overtake Tesla. Just like in 2020, with an unprecedented return at a brand price point shifting towards volume segments and an acceleration of self-funded growth in Q3, Tesla's price is challenging OEMs and sending a warning of relevance to the traditional. Tesla is in a position to change the traditional zero-sum game into a negative one and appears more mature than other OEMs nowadays, he stated. What are your thoughts on the current pricing of Tesla stock? Tell us in the comments section below. Additionally, while you're still here, feel free to. On your screen, select one of these two videos. I'll see you over there.